For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Recently, the stock market has seen divergent views regarding Palantir Technologies. On one hand, 4 billionaires have decided to sell their shares, a move that has raised eyebrows across the investment community. On the other hand, several analysts have increased their price targets for Palantir stock, with some reaching as high as $75. This contrasting sentiment has created uncertainty, leaving many investors wondering whether now is the right time to buy, sell, or hold their positions. In today's video, we will delve into both the potential benefits of holding onto Palantir shares and the risks that could arise from such a decision. By exploring these factors, we aim to provide you with a well-rounded perspective to help guide your investment strategy. Palantir Technologies, known for its innovative artificial intelligence-powered analytics platform, has had a stellar year in the stock market. This year alone, its stock price has surged by nearly 285%, driven in large part by the growing hype around artificial intelligence and its transformative potential across industries. This remarkable rise has positioned Palantir as one of the standout performers in the artificial intelligence sector, attracting attention from both retail and institutional investors. The company's platform, which leverages artificial intelligence and machine learning to analyze complex datasets, has proven instrumental in solving real-world problems for businesses and governments alike. With its user-friendly interface, even individuals without technical expertise in artificial intelligence can utilize its tools to visualize and interpret data effectively. According to TipRanks, the average Wall Street analyst price target for Palantir stock suggests a potential downside of approximately 48%. Some analysts argue that the stock's current valuation is unsustainable, especially given the broader market environment and Palantir's earnings outlook. However, there remains a faction of analysts who maintain an optimistic stance, asserting that the stock has further upside potential. This split opinion underscores the complexity of evaluating high-growth stocks like Palantir, where enthusiasm for cutting-edge technology often clashes with traditional valuation metrics. One of the most debated topics among analysts is Palantir's earnings projections for the year 2025. Forecasts vary widely, with some analysts predicting modest growth while others anticipate earnings to double during this period. This disparity reflects the uncertainty surrounding Palantir's ability to capitalize on its growth opportunities and maintain its competitive edge in a rapidly evolving market. In markets characterized by high valuations, earnings projections often become a focal point for investors, as they provide a tangible measure of a company's financial health and profitability. To evaluate a stock's valuation, analysts often turn to the price-to-earnings ratio, a widely used metric that compares a company's market capitalization to its earnings or its stock price to its earnings per share. For example, if a company has a stock price of $20 and reports earnings per share of $2 over the past year, its price-to-earnings ratio would be 10. This metric helps investors determine whether a stock is undervalued or overvalued relative to its earnings. Different sectors typically have varying price-to-earnings ratios, influenced by factors such as growth potential and risk levels. However, it's important to note that the price-to-earnings ratio is just one tool among many, and relying solely on it can lead to an incomplete assessment of a stock's value. Long-term investors, who typically have a time horizon of 5 to 10 years, often place less emphasis on near-term metrics like the price-to-earnings ratio. Instead, they focus on a company's fundamentals, competitive positioning, and long-term growth prospects. This approach allows them to ride out short-term volatility and benefit from compounding growth over time. In contrast, institutional money managers who operate on shorter investment timelines of 12 to 18 months tend to prioritize earnings data and other short-term indicators. While retail investors don't necessarily need to mimic the strategies of professional money managers, it's still valuable to monitor their activity, as institutional inflows and outflows can significantly impact stock prices. Examining earnings projections can also provide valuable insights into a company's near-term outlook. A wide range of estimates often signals uncertainty among analysts, suggesting greater room for error and potential valuation adjustments. Conversely, a tighter range of projections indicates a clearer consensus and less uncertainty. For Palantir, the consensus diluted earnings per share estimate for 2025 stands at 31 cents, which represents a 48% increase from the 2024 consensus estimate of 21 cents. The low estimate for 2025 is 25 cents, implying a 19% increase, while the high estimate of 42 cents suggests a potential doubling of earnings. These projections highlight both the opportunities and challenges that lie ahead for Palantir as it navigates a competitive and dynamic market landscape. Recent analyst actions further illustrate the divided sentiment around Palantir. Argus Research downgraded the stock earlier this month despite the company reporting strong earnings for the third quarter. Joseph Bonner, an analyst at Argus, cited concerns over Palantir's valuation, noting that the stock's tripling in price has led to lofty expectations for future earnings growth. He also raised questions about the size of Palantir's addressable market and the level of competition it may face as it seeks to expand its presence in the commercial sector. Bonner's cautious outlook serves as a reminder that even companies with cutting-edge technology must contend with market realities and competitive pressures. On the other hand, Dan Ives, an analyst at Wedbush, recently reiterated his outperform rating on Palantir and raised his price target from $57 to $75. Ives expressed confidence in Palantir's ability to capitalize on the growing adoption of generative artificial intelligence and its expanding use cases across industries. He views 2025 as a pivotal year for artificial intelligence, with Palantir positioned to benefit from increased demand for its software solutions. While Ives' price target implies only about 15% upside from current levels, his bullish outlook highlights the potential for Palantir to play a significant role in the artificial intelligence revolution. Palantir shares have delivered an extraordinary year-to-date gain of 285%, driven by robust financial results and growing optimism about its critical role in the expanding artificial intelligence economy. Despite this impressive performance, several prominent hedge funds and institutional investors made significant changes to their Palantir holdings during the third quarter, either reducing or liquidating portions of their stakes while reallocating funds to other assets, including the Vanguard Information Technology ETF. One notable example is Ken Griffin's Citadel Advisors, which drastically reduced its position in Palantir by selling 5,100,000 shares. This reduction represents a sharp 91% cut in its holdings. At the same time, the fund increased its investment in the Vanguard Information Technology ETF by purchasing 14,521 shares, marking an over 3,178% increase in its stake. This substantial reallocation suggests a strategic move toward diversified exposure within the technology sector, while potentially managing risks associated with holding individual stocks like Palantir. Similarly, Israel Englander's Millennium Management sold 4,400,000 shares of Palantir, representing a 90% reduction in its position. Concurrently, the hedge fund initiated a small position in the Vanguard Information Technology ETF by purchasing 2,388 shares. This decision aligns with the fund's strategy of maintaining exposure to technology-driven growth while balancing risk through diversification. David Shaw followed a comparable approach by selling 8,700,000 shares of Palantir, which reduced its stake by 45%. Like the other hedge funds, David Shaw opted to invest in the Vanguard Information Technology ETF, acquiring 12,259 shares to establish a new position. These moves highlight a broader trend among institutional investors who are seeking diversified exposure to the technology sector's growth potential, particularly within the rapidly expanding artificial intelligence landscape. Cathie Wood's ARK Invest also made adjustments to its Palantir holdings. Through the flagship ARK Innovation ETF, the fund sold 100,804 shares of Palantir Technologies. This trade, valued at approximately $6,660,000, based on the closing price of $66.05, reflects a shift in strategy. Despite the sale, it is essential to note that some analysts remain optimistic about Palantir's long-term prospects. Wedbush analyst Dan Ives and a Bank of America analyst recently reiterated their price target of $75 per share for Palantir, citing its significant growth potential amid the artificial intelligence revolution. This sentiment underscores the duality in investor perspectives, where some choose to lock in gains while others remain focused on the company's promising future. Although Palantir's meteoric rise has been rewarding for many investors, concerns about its valuation are becoming increasingly prominent on Wall Street. Among 20 analysts covering the company, the median price target is $38 per share, which implies a potential downside of 42% from the current share price of $66. These valuation concerns likely influenced the decisions of institutional investors to reduce their stakes. Meanwhile, the Vanguard Information Technology ETF is emerging as an attractive alternative for those looking to maintain exposure to artificial intelligence-driven growth while mitigating the risk of steep declines associated with individual stocks. This ETF tracks the performance of 314 companies within the technology sector, offering exposure to industries such as semiconductor manufacturing, cloud services, software development, and hardware production. The S&P 500, often considered the best measure of the United States stock market's overall performance, includes companies from all 11 market sectors. However, the technology sector has consistently been the primary driver of growth. Since 2010, this sector has contributed 32% of global equity returns and 40% of United States equity market returns, according to data from Goldman Sachs. This dominance is further underscored by the sector's robust financial performance. Earnings per share for the global technology sector have surged approximately 400% since the pre-financial crisis peak, while the combined earnings of all other sectors have risen only 25% during the same period. The Vanguard Information Technology ETF's top holdings exemplify the strength and innovation within the technology sector. These include Apple at 15.7% of the fund, Nvidia at 15.4%, Microsoft at 13.3%, Broadcom at 4.5%, and Salesforce at 1.8%. Each of these companies is actively leveraging artificial intelligence to enhance its products and services. Apple recently introduced a suite of artificial intelligence features for its iPhones and MacBooks. Nvidia remains the industry leader in data center accelerators, a critical component for artificial intelligence applications. Microsoft has incorporated generative artificial intelligence tools into its Office software suite. Broadcom is at the forefront of developing custom accelerators for artificial intelligence, and Salesforce continues to integrate AI-driven features into its customer relationship management solutions. The Vanguard Information Technology ETF stands out for its ability to provide consistent returns over various timeframes. Over the past 1, 3, 5, and 10 years, it has outperformed the broader S&P 500, demonstrating its resilience and growth potential. Additionally, the ETF offers a competitive expense ratio of 0.1%, meaning investors pay just $1 annually for every $1,000 invested. This cost efficiency compares favorably to the industry average of 0.95%. While volatility remains a characteristic of technology stocks, the ETF's diversified portfolio offers a balanced approach to capitalizing on the ongoing artificial intelligence revolution. In the end, Palantir Technologies has emerged as one of the most talked about stocks in the artificial intelligence sector, thanks to its impressive market performance and innovative solutions. However, the stock has also sparked debate among analysts and investors, with concerns over valuation and market competition balancing the optimism surrounding its growth potential. Whether you choose to hold, buy, or sell, understanding both the opportunities and risks associated with Palantir is crucial. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.